there is this immense expectation of immediate finality, right?
Oh, absolutely. The ink dries on the paper, it's logged into some digital registry, and you naturally assume you can just walk right through the front door of your new life.
Right. You think it's neat, clean, perfectly categorized, but imagine showing up with your shiny new keys, and you find out the previous owner has literally barricaded the driveway with like 5-ton concrete blocks.
Yeah. That would be a shock.
Exactly.
Yeah.
Suddenly that legally binding piece of paper doesn't actually mean much, at least not until the physical real-world obstacle is actually moved out of the way.
It is the ultimate collision between theoretical agreements and, well, physical friction.
And that collision is exactly what global markets are desperate trying to price in right now. Welcome to Market Recap. I'm Daniel.
And I'm Mira.
Today is Thursday, April 9, 2026, and this deep dive is designed to be your daily market news briefing. Our goal today is to help you understand not just what happened in the markets, but the fundamental logic, the narratives driving these massive daily moves.
We are going to look under the hood of the algorithms and the headlines. But before we begin, we do want to briefly assure you that while this deep dive will cover some highly politically charged global events, our analysis strictly focuses on the market impact.
Yeah, we're not endorsing any political viewpoints or actors here. We're simply tracking how capital is reacting to these developments completely impartially.
Absolutely. And as a quick disclaimer, please remember that this show is for market context and educational discussion only. This does not constitute personal investment advice or an investment recommendation.
With that out of the way, let's jump right into the overarching question that defined the morning. Session 1. What set the stage before the U.S. session?
So, to really understand the wild cross-currents of Thursday's trading, we have to establish the massive momentum carrying over from earlier in the week. The macro backdrop here is just absolutely crucial.
Right, because we came into Thursday with the market collectively trying to figure out if Tuesday's historic rally was a permanent shift or just a premature sigh of relief.
Exactly, because on Tuesday, April 7, President Trump announced a U.S.-Iran ceasefire agreement. And the market reaction to that was a textbook case of equity risk premium compression.
Okay, let's translate that for a second, because equity risk premium is one of those academic terms that sounds super intimidating, but it's actually pretty intuitive.
It really is.
It's essentially a fear tax, right?
Yeah.
For 6 weeks prior to that ceasefire, we had escalating tensions, military strikes, and that massive blockade of the Strait of Hormuz. Investors demanded a premium, like a higher potential return, just to take on the risk of holding stocks instead of safe government bonds.
Precisely. The systemic demand for downside protection was basically suffocating the broader market. And the very second that ceasefire was announced, that fear tax vanished.
It's just evaporated.
Yeah. The mathematical models suddenly didn't need to account for a catastrophic regional war. So we saw a historic 1,300-point rally in the Dow, and crude oil plunged 15% as the market assumed energy supplies would normalize.
So entering Thursday, the fundamental question the market had to answer was, is that geopolitical risk premium permanently gone, or is it coming back?
And overnight into Thursday, we got two incredibly conflicting answers to that question. First, we got what looked like a solid diplomatic floor.
Which happened on Wednesday, April 8, at around 5 p.m. Eastern Time, right?
Yeah.
The White House confirmed that Vice President J.D. Vance will personally lead the weekend negotiations in Islamabad.
Right. And from a macroeconomic perspective, deploying the vice president is not a trivial move. It signals a high degree of institutional commitment to the diplomatic track. Exactly. It provided a baseline of confidence overnight that this fragile 2-week ceasefire might actually hold. It essentially set a floor for risk assets before the U.S. markets even woke up.
But I want to pause on that, because here is where it gets really interesting. This is where that paper contract versus barricaded driveway metaphor comes back into play.
Oh, the physical reality check.
Yeah, because just a few hours after that diplomatic announcement, on Thursday, April 9, at 9:30 a.m., Iran Standard Time, which translates to 2 a.m. Eastern Time, Iran announces that ships still have to use alternative routes through the Strait of Hormuz because of the presence of sea mines.
And the moment that news crossed the wire, WTI crude oil prices began rebounding sharply in the overnight session.
And see, this is exactly why I always push back against the textbook assumption that markets price things perfectly and instantly.
Well, the models try their best.
But they fail here. The academic efficient market hypothesis assumes that on Tuesday, the ceasefire document is signed, so the market instantly recalculates all future cash flows, assuming global shipping is completely back to normal.
Right, which assumes zero friction.
Exactly. It's an absolute illusion of instant information diffusion. It's honestly absurd to assume that a political piece of paper signed in a boardroom magically and instantly clears physical, explosive sea mines from one of the most important global maritime choke points in the world.
I will concede that the mathematical models struggle heavily with the friction of physical supply chains. The efficient market hypothesis assumes rational, instant discounting of news, but you cannot instantly discount the physical logistics of mine clearing operations.
No, you can.
Those operations take specialized vessels, weeks of time, and immense logistical coordination.
Which is exactly where the human element comes in. For you, as an active listener and investor, this is the classic hopeful edge. If you understand the inevitable lag between political headlines in Washington and physical, muddy realities in the Middle East, you have an inherent advantage.
Because the initial reaction was incomplete.
Yes. The algorithmic market reaction on Tuesday, indiscriminately dumping oil by 15%, was fundamentally incomplete. It accurately priced in the politics, but it failed entirely to price in the physical reality of a mined waterway.
Which brings us perfectly to the economic data that dropped just before the opening bell, adding an entirely different layer of complexity to the morning. At 8:30 a.m. Eastern Time on Thursday, we got a highly anticipated mixed data dump.
Oh boy, yeah. The data that really highlighted the structural tug-of-war happening within the Federal Reserve.
Exactly. First, the delayed February core PCE inflation data came in showing sticky price pressures at 3.0%, with headline PCE at 2.8%.
And just for context, for anyone listening, the core PCE is the Federal Reserve's ultimate truth-teller gauge. It's their preferred measure of inflation because it strips out the volatile stuff like food and energy.
Right. And what this specific 3.0% print tells us is that even before this massive March oil shock in the Middle East happened, baseline inflation was already refusing to die down to the Fed's 2% target.
It's just stubbornly stuck.
Yes, and this permanently elevates the risk-free rate. We saw the 10-year U.S. Treasury yield hovering stubbornly around 4.28% all morning. When you have a higher risk-free rate, it structurally elevates the discount rate applied to future corporate cash flows.
So in plain English, a dollar earned by a company 5 years from now is worth significantly less today if interest rates are high, which traditionally forces a massive compression in tech and growth stock valuations.
Exactly. But wait, because at that exact same time, 8:30 a.m. Eastern, we get the U.S. initial jobless claims data, and it jumps to 219,000, which actually exceeded Wall Street estimates.
And that acts as a powerful dovish counterweight.
Right, it does. Think about the Fed's dual mandate: control inflation and maximize employment. Just a week ago, we had that shockingly hot jobs report with 178,000 new jobs, which basically crushed any hopes for an imminent interest rate cut.
But this new higher jobless claims data shows genuine cracks forming in the labor market.
So the market is completely trapped in this paradox. Sticky PCE inflation screams we have to keep rates higher for longer, but rising jobless claims hint that the Fed might still need to cut rates to save the labor market.
So to wrap up this incredibly tense pre-market setup, we had the U.S. session positioned for a massive multi-front clash. On one side, you have sticky inflation fears and physical energy constraints driving oil prices right back up.
And on the other side, you have hopes for the Islamabad geopolitical negotiations and a slightly cooling labor market offering a glimmer of hope for rate cuts.
Exactly. That overnight tug of war perfectly set the stage for our next major question. But first, we'll take a very quick break.
We'll be right back.
Welcome back. Let's dive into session 2. What moved markets during U.S. trading hours?
Well, given that intense morning setup we just outlined, the U.S. market unsurprisingly opened with moderate losses. That sticky inflation data and oil continuing its steady climb really weighed on equities right out of the gate.
Yeah, WTI crude ultimately rose 3.66% on the day to close at $97.87 a barrel.
Right. But what is truly fascinating here is the steady, fiercely resilient intraday recovery the broader market managed to stage despite all that.
And a massive part of that recovery came directly from the technology sector, but specifically the physical infrastructure side of tech. Right at 9 a.m. Eastern Time, a company called CoreWeave announced an expanded $21 billion agreement to provide AI cloud capacity to Meta platforms.
And that contract is locked in all the way through 2032. If we pull back and connect this to the broader macro landscape, this deal is the ultimate manifestation of the $690 billion AI capital expenditure sprint we have been tracking.
It's been massive.
The biggest companies on Earth, Amazon, Alphabet, Microsoft, Meta, they're locked in an unprecedented, monumental battle for physical land, electricity, and compute power. We call them hyperscalers because they're operating data centers on a scale that actually strains national power grids.
Which is a wild concept when you stop and think about it. I mean, it explains why Microsoft recently reported an $80 billion backlog in Azure cloud orders. It wasn't because of a software glitch, you know?
No, it was because of severe physical power constraints.
Right. They literally cannot find enough electricity to plug in the servers their clients are demanding.
Exactly the point. And in a high interest rate environment where that 10-year treasury yield refuses to drop below 4%, companies cannot rely on simple hype or multiple expansion to boost their stock prices.
They can't just sell a dream anymore.
No, they cannot just promise future growth. They have to rely on brute force, undeniable earnings expansion today. These multi-year, multi-billion-dollar physical infrastructure deals provide exactly that.
They provide resilient, legally binding, long-term cash flow visibility, which is precisely why institutional capital is so aggressively rotating into sectors that provide the picks and shovels for this AI supercycle.
Now, tech hardware starts pulling the entire market up by its bootstraps, but then we get a massive midday geopolitical pivot that throws a wrench into everything.
Oh man, yeah. At 11:40 a.m. Eastern Time, which was 6:40 p.m. Israel Daylight Time, breaking news hits that Israeli Prime Minister Benjamin Netanyahu authorized direct peace negotiations with Lebanon to disarm Hezbollah.
This is a critical development for risk assets. Just a day prior, Israel had launched massive strikes in Lebanon, exposing a terrifying loophole in the U.S.-Iran ceasefire deal.
Because the market was operating under the fear that the Northern Front would shatter the entire fragile truce before Vance even landed in Islamabad.
Precisely. So when Netanyahu officially authorized direct talks, it instantly reversed the morning's lingering risk-off sentiment. The S&P 500 erased its morning losses entirely and began to aggressively rally.
But if you thought the volatility was over, you would be wrong. Late in the afternoon, right around 2:30 p.m. Eastern Time, which is 10 p.m. Iran Standard Time, we get a massive curveball.
Right, from Iran.
Yeah, Iran's new supreme leader, Mojtaba Khamenei, posts a highly defiant warning on X, explicitly stating they won't allow aggressors to go unpunished.
And the market impact was violent and immediate. It re-injected risk directly into the tape, keeping crude oil highly elevated and firmly capping the equity rally right as we headed into the final hour of trading.
Because the algorithmic trading bots saw the headline, scraped the aggressive keywords, and treated it as a sudden, unpredictable risk shock.
Yes, the machines took over.
See, this is the disconnect between price and intrinsic value that I find so incredibly frustrating as a practitioner. An algorithm scrapes a social media post, registers aggressive rhetoric, and indiscriminately dumps millions of shares, causing a massive gap down in the charts.
It's indiscriminate selling.
Totally. But let's apply some common sense. The intrinsic fundamental value of the 500 largest companies in America does not drop by billions of dollars at 2:30 in the afternoon simply because of a post on X.
I hear that, but the market's job is to price in the probability of tail risk. If that aggressive rhetoric translates to a renewed blockade or a military strike, the discount rate changes fundamentally. The algorithms are just reacting to a change in probabilities.
But that assumes geopolitics is a random natural disaster, like an earthquake. It isn't. Geopolitics is sequential, human game theory. Think about the timing here.
Okay, lay it out.
Vice President J.D. Vance is literally packing his bags to fly to Islamabad this weekend for high-stakes, historic negotiations. In any negotiation, whether you are buying a car or hashing out a global ceasefire, what do you do right before you sit down at the table?
You posture.
Yes, you project maximum strength to increase your leverage. This rhetoric isn't a random escalation. It is a calculated poker move. Algorithms routinely misprice these events because they don't understand the developing logic of a political chessboard.
They just read the word punished and hit the sell button.
Exactly. And human investors who panic sell into that algorithmic gap down are quite literally just handing over their money to the machines.
That is a fair critique. I will readily admit that academic models are highly constrained when it comes to pricing in human brinkmanship. The models assume all actors are perfectly rational and that risk is a mathematical constant.
But we know that's not true.
Right. As we saw late Thursday afternoon, human emotion, pride, and political posturing absolutely drive the intraday tape. The true, fundamental price discovery of what that rhetoric actually means won't happen until the diplomats sit across from each other over the weekend.
So, to wrap up the actual trading day, despite the morning inflation fears, the sea mines, and the afternoon geopolitical posturing, equities managed to close solidly in the green.
The S&P 500 rose 0.62% to close at 6,824.
And tech hardware vastly outperformed the broader market, while crude oil stayed highly elevated near $98 a barrel, which sets us up perfectly to look under the hood at the specific winners and losers right after this quick break.
Stay with us.
Welcome back. Let's move into session 3, corporate events recap and what to watch next.
While the macroeconomic tug-of-war was completely dominating the index level, we had some massive corporate catalysts on Thursday, April 9, that really defined the specific sector action.
Starting right before the bell at 8 a.m. Eastern Time, Amazon CEO Andy Jassy released his highly anticipated annual shareholder letter.
And he didn't just casually mention their $200 billion investment in data centers. He explicitly outlined the actual path to AI profitability.
Which is what everyone's been waiting for.
Exactly. He detailed their massive push into building in-house AI chips to reduce their reliance on outside vendors like NVIDIA.
Which provided the ultimate AI validation that the broader market has been so desperate for. There has been this lingering, heavy anxiety over whether these hyperscalers would actually see a return on their historic multi-billion-dollar infrastructure spending.
Right. Are they just burning cash, or is there a sustainable business model here?
And Jassy's letter provided that tangible proof of concept, showing how it lowers costs and expands margins. Amazon shares surged 5.61% on the day.
And because it is such a massive mega cap leader, that single stock move heavily dragged the market cap weighted tech indices higher.
Meanwhile, stepping away from the tech sector, we saw a truly fascinating divergence in the consumer space. I like to call this phenomenon the consumer barbell.
I like that term. Let's look at two totally different earnings reports that hit Thursday morning to see how the modern consumer is actually spending their money.
Perfect. At 7:30 a.m. Eastern Time, Constellation Brands, the massive beverage alcohol giant behind Modelo and Corona, reported a solid earnings and revenue beat. Their stock surged 8.53%.
Which demonstrates an incredibly resilient demand for specific premium discretionary items. Even with sticky 3.0% core PCE inflation eating into household budgets, consumers are clearly still prioritizing their spending on premium alcohol.
They are protecting their preferred vices, basically.
Exactly. But then, just an hour later at 8:30 a.m. Eastern Time, Simply Good Foods drops their earnings, and it was an absolute disaster.
Oh, it was brutal. They reported a massive $249 million non-cash impairment charge on their Atkins and OW1 brands, and they completely slashed their future revenue outlook.
The stock crashed 18.1% on incredibly heavy trading volume.
Yeah, and this perfectly highlights a rapid structural shift in consumer trends. The macro environment is tough with inflation, yes, but this was a severe, fundamental execution failure.
An impairment charge essentially means the company is formally admitting to Wall Street that the brands they previously acquired are no longer worth anywhere near what they paid for them.
And we really have to explain why that is happening. It isn't just that people are eating less. It is the rise of GLP-1 weight loss drugs like Ozempic and Wegovy.
The pharmacological shift.
Exactly. Consumers are fiercely abandoning legacy diet brands like Atkins because the entire paradigm of weight loss has shifted from restrictive snacking to pharmacological solutions.
The market looked at that, realized the legacy diet business model is functionally obsolete, and ruthlessly repriced the company's valuation to reflect that harsh new reality.
The contrast is truly striking. It proves that in a high-inflation environment, the consumer isn't dead. They are just becoming incredibly selective about where their dollars go.
Very selective.
Honestly, between Simply Good Foods crashing and Constellation Brands surging 8.5%, it looks like Wall Street has officially decided to ditch the diet and just go straight for the booze.
Yeah, I mean, with Amazon and Meta's AI doing all the heavy lifting to keep our tech portfolios in the green, we might actually be able to afford that $97 barrel of oil.
So, raise a glass to today's resilient market recovery. because dodging both sea mines and sticky inflation is definitely worth celebrating at the closing bell.
It certainly is a relief to see green on the screen after the immense volatility we've endured this week. But the market never truly sleeps, and the weekend carries massive risk.
It does.
So let's lay out the exact roadmap for the next 24 hours. Here's what you need to watch next. First, tomorrow at 8:30 a.m. Eastern Time, we get the U.S. March CPI data release.
And this is absolutely critical for the inflation narrative following today's sticky PCE print.
Second, we have the official kickoff of the vice president-led U.S.-Iran ceasefire negotiations in Islamabad. The tone of those initial meetings will set the direction for crude oil on Sunday night.
Third, keep a very close eye on physical developments in the Strait of Hormuz regarding tanker passage and those sea mines we discussed. Any confirmation of successful clearing operations will really ease energy markets.
Fourth, watch for any military escalations testing the boundaries of the ceasefire, particularly regarding those newly announced talks between Israel and Hezbollah.
And finally, listen closely for any Federal Reserve speakers reacting to Thursday's sticky PCE data and Friday's upcoming CPI data. Their tone will dictate exactly how the bond market moves next week.
So as we step back from the daily noise and look at the absolute big picture, what does this all mean for you as an investor?
What's the takeaway?
This raises a profoundly important question, and it is something I really want to leave you to mull over as you digest today's events. We are currently watching the two most important resources in the modern global economy aggressively compete for capital.
Okay, break that down.
On one hand, you have the physical energy, the crude oil required to literally move the world and keep the lights on. On the other hand, you have the physical infrastructure, the data centers and chips required to build artificial intelligence.
Right.
If AI is going to require historic, unprecedented amounts of electricity to power these hyperscale data centers, how will tech valuations possibly hold up if the Strait of Hormuz conflict keeps the price of that energy structurally elevated at $100 a barrel?
That is a phenomenal, terrifying point. I mean, you can sign all the $21 billion cloud contracts you want, but if the local power grid costs an absolute fortune to run because global oil is stuck near $100 a barrel, that fundamentally alters the profit margins of the entire AI supercycle.
The paper contract hits the barricaded driveway all over again.
Exactly. The digital world can innovate all it wants, but the physical world always asserts its dominance eventually. Thank you so much for joining us for this deep dive into the market's underlying mechanics.
We appreciate you tuning in.
Let us know your thoughts on the market's resilience in the comments below.